Welcome to Echo Trade. I'm Jeff Roth here again with Zach Daniel from Digital Edge Wealth Management. Zach is the founder and head portfolio manager. And today we're talking about his portfolio within Echo Trade, Emerging Technologies Macro Hedged. So, Zach, thanks for being with us. How's it going?
Hey, thanks for having me, Jeff. It's going great. Summer's going along, and I'm happy to talk about my strategy at Echo Trader and give some context to everything. So, thanks for
Yeah,
having me.
yeah, we're excited to dive in and kind of learn more here from the horse's mouth. So, yeah, so I mean, let's dive right in. Let's start maybe a little high level and give us a broad strokes overview of what the goals of the portfolio are. Kind of what you're trying to accomplish within the strategy.
Yeah, it's definitely a growth-oriented portfolio. Of course, you have considerations for income and capital preservation in there, but overall, it's the strategy is an overall growth portfolio focused on emerging technologies, but understanding that the investment landscape in the macro sense has changed over the last couple of years, and
Hmm.
that looks to continue to move to the next decade. So things that had traditionally worked in 60-40 portfolios for the last 30, 40 years fundamentally started to change after COVID, and we think that change is going to continue. So you need a strategy and portfolio that addresses that, and that's really what was the focus was for this strategy was something nimble, able to kind of adapt to the changing landscape, a lot of inflation, and whether it's you know different interest rate environments and whatnot. But the main drivers of portfolio alpha is technology. It kind of always has been technology, and so we thought it was a very important piece to have that in there. Um, Obviously, in the environment, there's a lot of tech that may be unprofitable or overvalued, but through careful research and leveraging our own expertise, uh, we can kind of find those pockets of growth that, coupled with kind of a macro hedge view with interest rates and inflation, can kind of create a portfolio that can be very attractive for growth and some downside protection should economic conditions deteriorate or not go exactly as the strategy predicts. It's
Hmm.
not a huge downside fall there. So high level, that's kind of general.
Yeah, no, that's helpful. So, I mean, basically, if I'm hearing you right, you're looking at the last, several decades, and that technology has been the driver of growth and alpha for most strategies. And so, you're just focusing exclusively within this portfolio on those technologies, on that sector, broadly speaking, for the portfolio. Does that sound right?
Yeah, for sure. Kind of that over that top down approach is tech and
Uh huh.
technology driven, but obviously a bottom up approach for each individual company because not everything in tech is equally valued.
So, are you looking at certain sectors, like you said, from a top-down technology perspective? You're looking at certain sectors, or you're just looking from a technology umbrella whole, and then, like you said, bottom up, looking at sector agnostic, but just looking at what specific companies and names you guys see as driving growth and providing value for the portfolio.
Yeah, it's relatively sector agnostic. We have elements in the portfolio that address AI, machine learning, um,
Hmm.
just broad tech moats, leveraging social media and critical mass of users. But it is relatively sector agnostic. I would say probably the only sector that we've had we are, you know, have careful attention to is the semiconductor space.
Uh huh.
We do believe that chip manufacturing and is going to be a big driver over the next decade as AI becomes more implemented and GPUs are used more in machine learning algorithms. But we're relatively sector agnostic. We do have a special focus on where the technology platforms are going to be in 5 years from now. So how is the AI tech machine learning space in general going to develop and grow to where what companies are looking 3 to 5 years down the road that
Uh
have been
huh.
developing tech for the last 3 to 5 years in anticipation of this kind of I wouldn't say revolution as of yet, but
Hmm.
movement into those spaces. So I would say for like a quick example is Amazon Web Services started 10, 15 years ago. Amazon wasn't quite sure where that was going to go.
Hmm.
They developed the product, and it grew. The product and market grew to accept it, and that's
Yeah.
where people behind the scenes aren't really thinking about 5 or 10 years down the road. So that's where we're trying to identify companies and products that are going to grow, are going to be the market's going to grow into them. So they might not be massive yet, but it takes time for the market to kind of come to those
Yeah, you're
realizations.
looking to be on the leading edge of those investments, and so when it comes to fruition, then you guys are going to profit nicely.
Yes, exactly. And then I want to the other side of the portfolio. We have a very strong inflation thesis that
Hmm.
while right now we are in secular disinflation, the overall trend for this decade is inflationary. The kind of structural forces that are existing from both the fiscal and monetary side of the U.S. Budget constraints, the debt side, servicing the debt side, and also just general trends in a multipolar world where there's more friction in trade. There's more, hostile actors. There's more focus on kind of securing supply chains, and that comes at a cost. And so,
Hmm.
a lot of the forces that were contributing to the low inflation over the last couple decades have structurally started to shift, and we saw that kind of accelerate during COVID. And we do think that there will be bouts of inflation comes down, and it may stay there for a period of time, but the general trend is inflation is going to be a staple of this investing decade.
Yeah.
And to kind of address that is bonds have only been bonds have basically been in a state of stable slash lowering inflation for the last 40 years. You
Hmm.
change up that cocktail, and bonds are not as attractive an investment as they maybe have been in prior investing environments. So we're focused more on that side, looking at commodities and energy, which historically, relative to the S&P 500, are at historic lows from a valuation perspective.
Yeah.
Um, have been largely neglected from capex investing. If you look at capex investing for the energy industry, it's at historic lows. Even when energy prices were spiking last year, there was no increase in you know existing or new supply. Uh, so we think there's a very strong supply constraint in energy. That right now, demand has also been falling. So we haven't seen we haven't seen those forces collide yet. But with inflation being where it is, and the overall landscape for fossil fuels, um, we think that's a very good setup for a reversal. And even if we don't see a massive reversal in energy prices in the coming years, a lot of those companies are really well capitalized compared to where they were 10 years ago. They're paying very healthy dividends. They have a lot of their debt locked in for 20, 30 years. So even with interest rates, you know, coming up, and they have obviously a large fixed capital base, it should be just fine for those companies. And so that's another area that we see exciting opportunity.
Yeah, I mean, you touched on a handful of things there. So obviously you have built the portfolio from looking at the market conditions and specifically for a continued inflationary environment. And like you said, with that, one of the reactions of that is the bond market and then how that looks from a value standpoint and from an investment standpoint. So a typical 60-40 or 70-30, 60% equities and 40% fixed income or bonds they're investing in as a kind of a diversification, risk management technique. You guys are going away from that, saying, "Hey, the bonds are not going to be providing much value, moving forward through this type of a period and environment." And so, in exchange for that, you're looking at alternatives such as commodities and energy as a replacement for that part of the portfolio. Is that what I'm hearing?
Yeah, And bonds, they still have their place, and I do think that there's pockets of opportunity in the um, bond valuations and bond market, and so we can take advantage of that as we see fit. Just recently we've added a little bit more bond exposure um, where we had almost none before. But
Uh-huh.
that's part of the nice thing about the strategy is it's very nimble and kind of adapting to what's happening in real time and what we
Yeah.
see forecasting 3 6 months from now. But in
Mhm.
general, we do see more opportunity in the energy and commodity space from a dividend paying standpoint and from a valuation perspective.
Mhm.
Um, a lot of I do think a lot of the movement and the hesitancy of existing energy players to expand their supply has been the ESG kind of movement. Um,
Mhm.
this kind of expectation that renewable resources were going to eradicate the need for fossil fuels, over time, and so large investment in bringing on new supply just seemed not only not feasible, but regulation has become a lot stricter, and
Mhm.
costs have definitely gone up. So, but as we kind of get into this decade, people are starting to realize that the energy density that fossil fuels provide cannot be supplanted yet by
Mhm.
renewable energy, and it's not even close. Um,
Yeah.
to meet our energy needs, we need fossil fuels, and we need a lot of them. So
Mhm.
some of that kind of investor sentiment and realization shift, I think, is going to be happening over the foreseeable future, and it will lead institutional and regular investing back into energy and commodities, which have been rather neglected and been on a downtrend for the better part of a decade.
Yeah, because you touched on it, the ESG, and so for people that don't know, it's environmental, social, and governance. And so there's been almost mandates and some lots of large institutional investors that they are investing primarily in ESG, which is looking at environmental impact and social impact, et cetera, and to the neglect of the fossil fuels, which, like to your point, that maybe that's a certain causation of the good value that you're seeing right now in those areas and taking advantage of that. And then people are going to have to come back to that, which will then increase the value even more of your existing holdings. And Jim Boyd, so I mean, with that, that kind of ties into another thing that we want to kind of cover. Obviously, risk is a massive concern for everybody, and they want to know how much they're putting on the table, how much they're risking. So, where would you guys kind of quantify yourselves in terms of on a risk profile, low, medium, or high, and what kind of things are you doing to actually mitigate that risk? Which you touched on a little bit here, but we can kind of talk about that specifically.
Yeah, no, it's a good question, and risk is a very tricky thing. It's almost subjective at times.
Hmm.
As we saw with Silicon Valley Bank or some other big companies, overnight they can go to zero where everyone thought it was safe, the bonds were safe. So risk is definitely something on the forefront of my mind, and something from I've carried from my past in digital asset investing. Uh,
Hmm.
you know, Thinking about risk a little bit differently than most people. Um, as far as the portfolio doesn't have a huge history to go through, be able to exactly point back to market down cycles and point to exact kind of downturns. But
Hmm.
you know, based on some of the risk measurement that we do, it's say the market was down 10% this year. We
Hmm.
wouldn't expect the portfolio to be down much more than that. We wouldn't expect to see the portfolio down 30%. If the
Hmm.
market dropped 30%, we wouldn't expect the portfolio to be down 60%. And a lot of
Hmm.
that has to do with some of the companies that we choose to be the safer part of the portfolio. They're very well capitalized companies with strong dividend payments, and that even if the economy goes into a period of deflation or recession, that those security prices we would expect to hold up better than a lot of the overall market. And of course,
Hmm.
the more tech driven positions, as their PE multiples fall down, and um, those obviously are more levered to downturns. So we're looking to balance those allocations, and depending on how overall, I would say is generally a high risk strategy, but it's not risking a significant amount of capital in a given year. Um,
Yeah. So you're looking, I mean, you're, if the market, takes a turn, then you guys would expect to participate in some of that
mhm.
downturn, but not to an exponential degree where you're losing more than
Yeah,
the market particularly, and then you're looking to outperform during bull market runs. Is that kind of the
that,
consensus?
that's exactly right. And of course, we'd like to outperform during the down times too.
Hmm.
But a lot of that has to do with how we're positioned at that time. Currently at the start of the year, we were very heavy as far as our normal allocation from tech to other securities. We were
Uh-huh.
very heavy in the allocation, and that has waned as we've seen this rally and we've seen some overvaluation and exuberance
Hmm.
into a higher cash and safety position. So should a downturn commence in the next 3 to 6 months, we would expect the portfolio to hold up probably better than maybe what I forecasted a little bit earlier. But obviously, a lot of that has to do with personal decisions in the management of the portfolio. So I don't want to lead people, uh, give people any false information or make sure they know all the risks before they would invest.
Hmm.
But ideally, we'd like to outperform during the up and the downtime because the portfolio is so flexible.
Yeah.
But that's just something to think about. That it is a higher risk portfolio overall.
Yeah, that's helpful. I mean, so kind of going into more specifics of what you're investing in, which we touch on a little bit. It sounds like it's very much, there's some themes to the portfolio on the tech side, and then so some certain sectors that you had touched on kind of previously. Are there certain sectors that you said you're sector agnostic, but are there certain kind of sectors that you're looking at that you guys are looking at specifically now and in the future? You mentioned, I think, AI, some of the semiconductor space. Are there certain sectors that are attractive to you right now?
Yeah, the AI space is attractive. We had strong positions in that we've scaled back on a little bit as the exuberance is, but we remain really long term bullish in those scenarios.
Hmm.
Um, and a lot of I would say most of our exposure from those tech positions are not major cap tech stocks. So
Yeah.
not the Apple, the Microsoft, the Google, which have greatly outperformed this year, but so of our positions,
Hmm.
because we see that the opportunities on those are capped,
Yeah.
um, and so we see greater opportunity in smaller to mid cap uh, players that are have differentiated technologies and kind of higher growth prospects.
Uh-huh.
The semiconductor industry, uh, we see if you look at the balance of ETF, we see some companies being very, in a much better position than others. So we're kind of careful in how we select for that. But we like that space. Um, we have dabbled in companies related to digital currency, so um, directly or indirectly, and that is much more of a momentum trade. Um,
Hmm.
Currently, we have a very small allocation to that, but prior at the beginning of the year, we had a lot of information and analysis that pointed to a strong rally in those. So that part of the portfolio, and that comes back with my own personal experience in that space. It is very hard to navigate and very volatile.
Uh-huh.
So having that personal expertise to really kind of shift through the noise and understand the signals of that particular asset class is been of great benefit because you know the returns in that space can be very pleasant if you're right, but obviously very dangerous if you're wrong. So it's
Hmm.
it all comes back to risk management. How heavy are those positions, and really a lot of it has to do with the timing of those positions. So
Hmm.
you know, right now we don't see as big opportunity in the digital currency space, but yeah, and then there's just we're looking at tech positions that have critical mass, kind of a critical mass of users, because data is everything. Data is a currency, and as you get those critical mass of users, you are not only harvesting their data but optimizing your own services based on their data. So we do think that tech platforms that have a fast growing user base present a very interesting investment opportunity.
Yeah, and to be clear, so we're with the portfolio. You're investing in individual companies, or are there any ETFs in
They,
there as
they,
well? Or
no, there's ETFs as well.
uh-huh.
There's some sectors that we you know based on either my personal expertise, there's some sectors that we don't see much differentiation. I would say something like utilities.
Yeah.
Um, the utility sector, there we don't see as much differentiation where we need to dig in and find the utility company
Hmm.
versus kind of a broad stroke of allocating that asset class as a whole.
Yeah.
Versus like when we talk about semiconductors, the semiconductor ETF is a much different story where we don't want the broad exposure. We think that there's much better opportunity picking out individual companies based on
Hmm.
whatever metrics we use to value them and where the market's valuing them. So there are ETFs. I would say currently it's probably maybe like a 20 to 30% exposure to ETF,
Hmm.
and then the rest is generally individual companies, um,
Got
and
it. And so
that's
what?
probably about where it stays normally.
Yeah, and so what's your process then for kind of determining what you want to put in the portfolio, whether it's an individual company or an ETF? What kind of screening process are you doing? What's your research look like? What's the analysis look like?
Yeah, so like I said, it starts with top down, kind of the macro, and then bottom up. Traditional valuation measures as far as just examining the balance sheet. Discounted cash flow model, depending on which security we're talking about. Uh,
Hmm.
Kind of looking at the sector overall. What's the sector health? What's the addressable market of this sector? How do we think the addressable market of this certain security is going to change over the next 3 to 5 years? So
Yeah.
we're talking about the energy industry. Midstream gas. If a company's in midstream gas, we see LNG being a big part of that growth over the next 10 years. How much of that growth is going to be captured by this company? How much do they have
Hmm.
now? What's their market share going to look like in 5 or 10 years? They got a couple facilities coming online, and they might gain market share in a category that's growing very rapidly. So that's
Yeah.
the kind of individual some of the individual thinkings that we do on each security. And we also look at regulatory. The regulatory environment is a big part of this. um, Especially if we're talking about oil and gas, energy, commodities, the tech. Uh, I think Congress is very behind on on realizing and understanding tech. If you watch
Hmm.
any of the hearings, but that opens that industry up to, I would say, onerous regulation.
Yeah.
And all it takes is a one broad stroke of a bill that gets passed without much understanding from the congressional authorities that are passing it to fundamentally change a tech company's entire business. We saw
Yep.
that with a little bit with Meta. Now, granted, Apple did it, but it really limited a lot of what Meta was doing business wise. Of course, Meta is a huge company, and there's so many different business facets. But so we're conscious about the regulatory environment. How in safe is a company from one change in regulatory code. So
Yeah, I mean,
yeah,
we're from the other side of the table. We're a tech company in finance, so it is a constant,
yeah,
daily reminder that we have to be very very cognizant of what's happening over there and what the regulators, what they're saying and what they any changes that they make. So we're seeing it firsthand. So that's definitely something to be aware of. So how much time do you think you spend on a given month or a given year on research?
it it really it's tough to add up the total amount. I
Yeah.
would say it depends on a given security too. I would say, you know one thing about this portfolio that I think is different than a lot of other portfolios is we're willing to go, a little bit heavier on individual positions that we have a high conviction in.
Yeah.
So where I think a lot of other portfolios, the practice is, well, this position was up 50%, we got to trim it a ton, trim it back
Hmm.
to if we have high conviction in a security, we're fine with it being very overweight, um,
Hmm.
because we're looking around and saying, well, what are we going to do with that capital otherwise?
Yeah.
And if there's no other better place to allocate that capital, then why are we trimming it? Um, so I would say I can certainly attest to my two highest conviction equity allocations in the tech sector. I've probably put 200 plus hours into each.
Yeah.
Um, Now, if those are exceptions, I would say normally those most equity positions are not researched to that degree, but they are also much smaller allocations.
But
Um,
that's 200 hours into like you said, just a few positions versus, I'm sure you're looking at several other companies on any given day and any given month and
yeah,
year that don't ever make it to the portfolio. So that's a significant amount of time that you're spending researching these and making these decisions.
yeah, and a lot of it goes with the broad macro thesis. A lot of the research goes into that because we have these individual positions, but depending on the overall investing macroeconomic landscape,
Hmm.
that can help decide a lot of the weight of those positions. So they might not go away. We just might not be as heavily weighted in them because interest rates are rising and PE multiples are expected to contract, and that heavily hurts tech and the high opportunity cost. You're able to get a 5% treasury, and there's a bunch of tech companies that are yielding nothing. So
Yeah.
there, you know, based on that broad macroeconomic environment, we might not change or eliminate positions, but we might trim some of those positions. So
Uh-huh.
um, that has a lot to do with it.
No, I mean, I think this has been fantastic. I really appreciate you taking the time, Zach. The portfolio is performing fantastically so far this year. So yeah, if anybody has any other questions, you can dive into your firm profile and find Zach and his emerging technology macro hedge portfolio on Echo Trade. Thanks for being here, Zach.